Hey everyone, have you ever wondered how the stock market actually works or felt a bit lost when you hear people talk about buying stocks? Well, you're in the right place. Today, we're going to dive into the basics of the stock market, how it works, how you can start investing, and a few tips to make your money work smarter, not harder. So, if you're ready to start your journey to financial freedom, keep watching and let's get started. Section 1. Understanding the basics. Alright, before we jump into how to invest, let's quickly go over what the stock market is and why people invest in it. So imagine you own a piece of a company like Starbucks or Apple. By owning this little piece, you're hoping that over time, the company will do well, and your small part of it will be worth more than when you bought it. That's essentially what buying a stock is, owning a tiny piece of a company. Now, the stock market itself is a place where buyers and sellers come together to trade these stocks. Think of it like a huge online marketplace, where millions of people and institutions buy and sell shares every single day. The prices go up and down based on supply and demand, and the overall performance of the market can be influenced by things like economic news, interest rates, or company performance. Section 2. How to start investing. Step-by-step guide. So, how do you actually go about buying stocks? Don't worry, it's easier than you might think. Let's break it down step by step. Step 1. Choose a brokerage. First up, you'll need to set up an account with a brokerage. Think of a brokerage as the platform that connects you to the stock market. There are a lot of great options like Fidelity, Robinhood, or Charles Schwab. Many of these platforms have apps that make investing as easy as ordering a pizza. Start with an app that's user-friendly and maybe offers some educational resources. Some brokerages even offer free stocks just for signing up, so you're starting with a small win. Step 2. Deposit funds. Once you have your account set up, it's time to add some money to it. You can start with as little as $5 or $10, just enough to dip your toes in. Most banks make it easy to transfer funds into your brokerage account, and once the money's there, you're ready to buy your first stock. Step 3. Find a stock you're interested in now. This is the fun part, choosing a stock. My advice is to start with companies you know and believe in. If you love tech, look at stocks like Apple or Microsoft passionate about the environment. Maybe check out some clean energy companies. Let's say you're a fan of Tesla and believe in its future. Buying even one share of Tesla means you're officially a part of their journey, and as they grow, so does your investment. Step 4. Placing an order. Once you've chosen your stock, you'll place an order. You might see terms like market order or limit order. A market order means you're buying at the current price, while a limit order lets you set a specific price at which you want to buy. Let's say you invest $100 in a stock that grows by 10% in a year. That's $110. And if you keep investing $100 each month, that growth can really add up over time, thanks to compound interest. Section 3. Beginner strategies for stock market success. Alright, so you know how to buy a stock, but what's next? Here are some simple strategies that beginners can use to build wealth over time. Strategy 1. Buy and hold. One of the simplest and most popular strategies is buy and hold. This means you buy a stock and hold onto it for the long term, ideally for years. The stock market historically trends upward, so holding steady can help your money grow over time. Imagine investing $50 every week in a year. That's $2,600. Over 10 years, with an 8% average return, you could end up with nearly $40,000. Strategy number 2. Diversification. Ever heard the phrase, "Don't put all your eggs in one basket"? That's what diversification is about. Instead of putting all your money into one stock, spread it across several companies. This way, if one stock dips, the others can balance it out. Say you invest in 5 companies. If one of them drops by 10%, the others might balance out your portfolio. Diversification helps you ride out market ups and downs more smoothly. Strategy 3. Dollar cost averaging, DCA. Dollar cost averaging means investing a fixed amount regularly, regardless of the stock price. You buy more shares when prices are low and fewer when they're high, which can help you avoid the risk of buying at a high price. If you invest $100 monthly, that's $200 a year. Over time, DCA can help lower your average purchase price, so you're not buying everything at the highest price. Section 4. Important tips on managing risk. The stock market can be exciting, but it's not without risks. Here are a few tips to help you manage that risk and stay confident in your investments. Tip 1. Know your risk tolerance. Your risk tolerance is essentially how much risk you're comfortable with. Some people are okay with big swings, while others prefer steady growth. Starting small can help you figure out your comfort level without risking too much. Let's say you have $1,000 to invest. If you're a cautious investor, you might put it in stable, established companies like Coca-Cola or Johnson & Johnson. For those okay with a bit more risk, newer tech stocks might be a better choice. Tip 2. Avoid emotional investing. One of the biggest mistakes is letting emotions guide your decisions. If the market drops, don't panic and sell right away. Successful investors stay calm and think long-term. Imagine you buy a stock, and a few weeks later, it drops by 10%. It's easy to feel anxious, but remember your long-term goals. Markets move in cycles and patience often pays off. Section 5. Practical tips to start right. Let's wrap up with some practical tips to get started on the right foot and avoid common mistakes. Tip 1. Start small. If you're new, it's okay to start with a small amount. Try $50 or $100 initially. As you learn more, you can gradually increase your investments. $100 a month may not seem much, but over a year, that's $200. With a 7% annual growth, that's an extra 84. Imagine this building over 10 years. Tip 2. Do your research before buying any stock. Take some time to understand the company's financial health and growth potential. This might seem time-consuming, but it can prevent costly mistakes. Thinking of investing in Amazon, research its performance, its competitors, and potential challenges. A little homework can go a long way. Tip 3. Reinvest dividends. Some companies pay dividends, which are like small bonus payments. Instead of cashing out, reinvest these dividends to buy more shares over time. This can compound your returns. If you have a stock with a 3% dividend and reinvest each year, even a small dividend can boost your overall growth. And that's it. Your beginner's guide to understanding and investing in the stock market. You don't need to be a finance expert or have loads of cash to start. Just take small steps, stay consistent, and keep learning as you go. Investing is a journey, so take it at your own pace. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and don't forget to hit that bell icon so you never miss an update. If you have any questions, drop them in the comments. I'd love to help you on your journey.